Brad Williams, Frugal Finance. What are government securities? Types and key information. Government securities are debt instruments issued by national governments to raise funds for various public purposes, including infrastructure, defense, and daily operations. In the U.S., these securities primarily include Treasury bills, Treasury notes, and Treasury bonds. These government-backed debt instruments come with the assurance of repayment, making them a low-risk investment choice. When an investor purchases government securities, they are essentially lending money to the government. In return, they receive a promise that the principal will be paid back at the bond's maturity date, along with any interest earned. These securities often pay periodic interest, coupons, and investors can choose to hold them until maturity or sell them on the secondary bond market. Government securities are seen as one of the safest investment options due to the creditworthiness of the issuing government. Governments issue these securities to fund budget shortfalls without resorting to higher taxes or cuts in services. For instance, issuing bonds allows the government to finance large-scale projects such as building roads, schools, and other infrastructure, as well as supporting military expenditures. U.S. government securities versus foreign securities? While U.S. government securities are widely regarded as risk-free investments, securities issued by foreign government carry additional risk. Foreign government bonds can be affected by political instability, economic downturn, or even default. A notable example is the 1998 Russian default, which sent shockwaves through global markets. However, U.S. Treasury securities are viewed as risk-free because the U.S. government has the ability to print money to meet its obligations, thus avoiding default. Despite being considered risk-free, government securities generally offer lower returns than corporate bonds. In a rising interest rate environment, they may underperform compared to other types of bonds. Types of government securities? Savings bonds. These bonds offer fixed interest rates and are typically purchased for long-term investments. Investors redeem the bonds at face value plus accrued interest after a set term. Treasury bills? T-bills are short-term securities with maturities ranging from a few weeks to a year. These bonds are sold at a discount and do not pay regular interest, but rather return the full face value upon maturity. Treasury notes, these are medium-term securities, typically with maturities ranging from 2 to 10 years. They pay semi-annual interest and can be a good choice for investors seeking a fixed return. Treasury bonds, long-term securities with maturities from 10 to 30 years. T-bonds pay interest every 6 months and are used to fund long-term government deficits. Buying government securities, the U.S. Department of the Treasury sells its securities directly to the public through treasurydirect.gov. Investors can also purchase these securities through brokers or financial institutions. Foreign government securities or Yankee bonds can be more complex to buy, often requiring specialized brokers and access to international markets. Controlling the money supply? Governments, particularly the U.S. Federal Reserve, use government securities to manage the money supply and control inflation. By selling bonds, the government can reduce the money circulating in the economy, which may push interest rates higher. Conversely, buying back these securities can increase the money supply, helping to stimulate economic activity. Pros and cons of government securities? Pros: offer a stable income stream. Low risk of default, making them attractive during periods of economic uncertainty. Some may provide tax advantages, such as exemptions from state or local taxes. Easily tradable in the secondary market. Cons: offer lower returns compared to other investments. Interest payments may not keep pace with inflation. Foreign government securities carry additional risk, including default. Conclusion: government securities are an important investment option for those seeking low-risk, stable returns. While U.S. Treasury bonds and notes are considered virtually risk-free, foreign government securities may carry more substantial risks. Government securities are a critical tool for financing public projects and managing economic conditions, and they are widely used by individuals and institution investors alike. If you have any questions or concerns about government securities, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.